Welcome to AK Shah's Foreign Exchange Made Easy class. Today is third session. Last day I have discussed currency and currency pairs. Today it will be continued. There are three categories of currency pairs: the major, the minor, the crosses, the exotic. The major currency pairs always include the US dollar. The major currency pair has the highest trading activity in volume and liquidity in the foreign exchange market since the presence of the US dollar as a pillar. Either it is a base currency or quote currency in most of them. Major currency pairs are Euro USD, USD JPY, GBP USD, USD CHF, USD SCAD, AUD USD, NZD USD. The minor currency pairs or crosses do not have US dollar but have other major currency either as base currency or quote currency in the currency pairs. For example, Euro CHF, Euro GBP, GBP JPY, etc. Now come exotic currency. The exotic currency pairs consist one major currency and the one currency from emerging country or developing country. For example, USD SEK, Swedish krona, USD RUB, Russian ruble, USD DKK, Danish krone, Euro HUF, Hungarian forint. The exotic pairs lack liquidity and volume because they are not traded as much as other foreign exchange pairs. Next, currency trading in India is allowed in the following pairs only: USD INR, Euro INR, GBP INR, JPY INR, Euro USD, GBP USD, USD JPY. There are 7 currency pairs. Out of these 4 currency pairs, the rate is directly available, namely USD INR, Euro USD, GBP USD, USD JPY. These rates are available from their respective central bank. But other 3 currency pairs, Euro INR, GBP INR and JPY INR, the rates are not available directly. These rates are computed by crossing the 2 rates, and one rate is common in 3 cases, that is USD INR. If you want to find out the rate Euro INR, then you take 2 rates. One is USD INR and another is Euro USD. You multiply these 2 rates, you get Euro INR. In the multiplication, USD will be cancelled, remains Euro INR. If you want to find out GBP INR, then you take 2 rates, USD INR and GBP USD, and multiply these 2 rates, you will get GBP INR. And for JPY INR, you divide USD INR by USD JPY, and in the process of division, USD will be cancelled and remains JPY INR. JPY will be the numerator, that is base currency, INR is the denominator, that is quote currency. The logic behind multiplication and division I will discuss later when I come to cross rate. Next, The financial benchmark India Private Limited FBIL, recognized by RBI Reserve Bank of India as an independent benchmark administrator, computed and disseminated the reference rate of USD INR, Euro INR, GBP INR, JPY INR. The USD INR reference rate is calculated based on actual spot USD INR transaction taking place on the electronic platforms during 1 hour time window from 11:30 hour to 12:30 hour IST on each business day in Mumbai. The Euro INR, GBP INR and JPY INR, which rates are to be computed by crossing. Here it is written, the reference rate are computed by crossing the USD INR reference rate of the day with the ruling spot currency rates for Euro USD, GBP USD and USD JPY, which are obtained from any electronic platform during the 1 hour time window from 11:30 hour to 12:30 hours IST on each business day in Mumbai. In currency market, the price of currency pairs for which direct prices are not available is called cross rate. The reference rate in respect of USD, Euro, GBP and JPY are published for 1 unit of USD, 1 unit of Euro, 1 unit of GBP and mind that 100 units of JPY. The currency market of India is regulated by SEBI, Securities and Exchange Board of India and Reserve Bank of India jointly. Now come base currency and quote currency, which I have already discussed. Here it is explained further. Every trade in foreign exchange market involves currency pair in which one currency is bought with or sold for another currency. In currency pair, the currency which placed first is called base currency, that is BC, and the other currency placed next is called quote currency, that is QC. The standard practice is base currency is placed first in currency pair followed by quote currency, which is used to value the base currency. For example, USD INR. Here USD is the base currency and INR is quote currency. Euro USD. Here Euro is base currency and USD is quote currency. GBP USD. Here GBP is base currency and USD is quote currency. In the interbank market, USD is the universal base currency except for some currency pairs such as Euro USD, GBP USD, AUD USD, NZD USD, where Euro, Sterling Pound, Australian Dollar AUD, New Zealand Dollar NZD are base currencies and USD remain as quote currency. The foreign exchange rate shows that 1 unit of base currency is priced by the quote currency and it is fluctuating time to time depending upon several factors. For example, a dealer quote a price of USD INR as 78.03. It means that 1 unit of US dollar has a value of rupees 78.03, that is the exchange rate is rupees 78.03 per dollar per base currency. Yeah, dollar is the base currency. Similarly, GBP USD is 1.13, means that 1 unit of GBP is valued at $1.13. That means GBP USD is $1.13 per pound per base currency. Application or depreciation. Whenever a base currency buys more of the quote currency, the base currency has strengthened or appreciated and quote currency has weakened or depreciated. When base currency buy less of the quote currency, then quote currency has appreciated or strengthened and base currency has weakened or depreciated. If the exchange rate of USD INR moves from rupees 78 to rupees 78.50, then the rate is appreciated, that is base currency appreciated and quote currency depreciated. Or if it moves from rupees 78 to rupees 77.52, then quote currency has appreciated and base currency has depreciated. Next, interbank market. Interbank market is made up of large scale currency transaction. Interbank market is made up for large scale currency transaction between banks around the world. It is the top level foreign exchange market where banks exchange different currencies. Dealers quote current prices for both buying and selling the currency, that is two-way price. The mechanism of quoting price for both buying and selling is called market making, like wholesaler. The vegetable wholesaler will quote prices for buying vegetable from farmers and will also quote prices for selling to vegetable retailer. Thus, the wholesaler is a market maker as he quoting two-way prices both for buying and selling. When bank quote prices for both buying and selling the currency, that is two-way price, the price quote for buying the base currency is called bid price and the price quoted for selling base currency is called offer or ask price. Suppose a bank quote USD INR spot price 70.05, 70.53 to a customer. In this quote, rupees 70.05 is bid price and rupees 70.53 is offer or ask price. Bid price means bank is willing to buy 1 unit of USD, that is base currency, from customer for a price of rupees 70.05. And when the bank is willing to sell 1 unit of USD, that is base currency, to a customer for rupees 70.53, it is called ask or offer price. Always remember, offer or ask price is always higher than bid price. The interbank market is made up of large-scale currency transactions between banks around the world. The transaction can be proprietary, that is taking place on behalf of banks' accounts or on behalf of banks' customers. The interbank market has predominant influence on the exchange rate around the world in the short term. The interbank market deals with the transaction that have a maturity of 1 year or less. This market can also be classified as interbank money market. In the interbank money market, both lender and borrower are banks and borrowing is on clean basis, that is without security. The period of borrowing is for standard tenor, which are overnight when 1 week, 2 week, 1 month to 1 year at monthly interval. There is no tenor beyond 1 year because the money market is only for 1 year. The overnight is most important and liquid. It is called call money in India and Fed funds in US. The rate in overnight money indicates the liquidity status for entire economy. If the rate remains persistently high, it is an indication that there is a shortage of money in the economy, and if the rate is persistently low, it indicates surplus money in the economy. The central bank keeps close watch on the overnight rate in the interbank market for implementing monetary policy and market intervention. Call money is the borrowing or lending of funds for 1 day, where money is borrowed or lent for a period between 2 days and 14 days. It is called notice money. Term money refers to borrowing or lending of funds for a period exceeding 14 days. Interbank market follows a floating rate system where the currency rate depends on demand and supply. It is an unregulated or decentralized system, meaning there is no specific location where these transactions occur. Instead, it is composed of thousands of interbank exchanges of currency at agreed upon prices and quantities. The prices come from market makers, usually the largest banks in the world. An interbank market is a marketplace where financial institutions like banks can trade and settle currencies with other countries' bank. The only difference between the interbank and foreign exchange market is that in the former only banks and other depository institutes participate, whereas the forex market includes everyone. Next come interbank rate. The interbank exchange rate is the rate that banks use when they are trading large amount of foreign currencies with one another. For large value merchant transaction, bank price it from interbank rate, IBR. IBR is the price available to the bank from the interbank market. They are used by banks to settle transactions between themselves and serve as a benchmark for exchange rates in the wider market. The IBR could vary from bank to bank. The variation is very small. may be in the range of 0.25% to 2% from bank to bank. It is mentioned earlier that the foreign exchange market is the world's largest financial market where trillions of currency transactions are traded daily. It is the most liquid among all markets in the financial world. The currency market is open 24 hours a day, 5 days a week. Foreign exchange market generally open to participants from all countries through a linkage of banks, foreign exchange dealers and brokers who are connected via network of telephone, computer terminals and automated dealing system. The market timing of recognized stock exchange in India for INR currency pairs is from 9 am to 5 pm Monday to Friday. After that they are closed, but the exchanges in foreign countries remain open and active. Since the currency market is open for 24 hours, 5 days a week, the market is most active when both US and Europe are open. The opening levels of OTC market are primarily dependent on the development of international markets since the closing of domestic market on the previous day. The opening level of currency is quite subjective and would vary from one participant to other owing to the impact of overnight development on the opening level of currency, and therefore the OTC market is generally not very liquid in the first few minutes of its opening. Gradually, market discover an equilibrium price through more and more transaction at which market clears buy and sell orders. This process of discovering an equilibrium price is called price discovery. Price discovery in spot markets is the process of determining currency price through forces of market demand and supply. The price discovery in future markets refer to the process of determining the future price through expected demand and supply. For example, in every valuation of INR currency, it is observed that at Interbank Foreign Exchange Market, the price of the currency has been opened first and gradually moved within a range throughout the day and finally settled against the US dollar, registering gain or loss over the previous close. In USD INR spot market, the spreads are wide at the time of opening and gradually start narrowing as market discover the price. Now come card rate. For small value transactions, bank publish standard price for the day called card rate. Card rate can differ across banks. Each bank sets its card rate based on a variety of factors such as the cost of acquisition foreign currency operating expenses and profit margin. The difference between IBR and card rate is high to cover the risks of price fluctuation. Due to banks' high volume of transaction, the spread for interbank exchange rate is quite small, with only a few pips. Pip is $0.0001. As a result, the bank's profit margin and other expenses related to supplying retail consumers for foreign exchange services, the spread in card rates is often greater. The interbank market consists of four main components. Number one, spot market. Number two, forward market. Number three, swap trade. Number four, sweep. The spot market, which entails transaction made for currency price at the exact time of trade. The forward market, which is an agreement to exchange currency at an agreed upon future date and price. A swap trade, which is a combination of both spot and forward. The banker buys the currency at the spot market current price and sells the equivalent amount in the forward market at a future date and price. SWIFT, Society for Worldwide Interbank Financial Telecommunication. SWIFT allows the parties to send and receive information about transactions safely and securely. The difference between bid price and ask price is called spread. The ask price is greater than bid price. Market with narrow spread, liquidity is more than that of wide spread. In narrow spread, the market is being actively traded with high volume, that is, a significant number of contracts is being traded and supply meets demand. In widespread, market is not actively traded and has low volume of transaction due to less demand of securities. Currency is considered the most liquid asset since bid-ask spread in the currency market is one of the smallest than the market of other underlying asset. The bid-ask spread can be considered as a measure of quantum of demand and supply for a particular asset. The bid represent demand whereas the ask represent supply, and the movement of the prices of underlying asset have an effect on the changes in demand and supply. In the case of large cap security, there is significant amount of liquidity. The spread is narrow and as the market is traded heavily, such as Reliance Industry, SBI, TCS, etc. Conversely, in small cap security, spread is wide due to low volume of trading, less liquidity, causing adverse effect on demand. The price quoted by market maker is valid for certain quantity of the currency pair and it may vary if the quantity for which quote is made is higher. The bid-ask spread can vary depending on various factors such as market condition, currency volatility, and size of transaction. For large value transaction, the bid-ask difference could be higher than for small value transactions. The exact bid-ask difference for a particular deal size could vary from bank to bank. Thus, for a USD 100 million transactions, spread is likely to be higher when compared to the spread for USD 1 million transaction. The bid-ask spread is called transaction cost, that is the gain on the market maker or an intermediary who keeps the market orderly. Price takers, that is the customer, buy foreign currency at ask price and sell it at bid price, where the market maker, that is bank or intermediaries, buy it at bid price and sell it at ask price. Since ask price is higher than bid price, so bank or intermediaries will make profit. Spread is an important parameter in assessing market liquidity, efficiency of market maker, and market direction. Today I stop the class here. Next day I will discuss this market liquidity, efficiency and market direction and cross rate. Thank you.